Hi, welcome to Know It Olly Eli5's ETFs. ETFs are exchange traded funds. What that means is exchange traded, just like a stock. You can trade these funds, these bundles of stock, on the open markets or the exchanges, just like the New York Stock Exchange or the Toronto Stock Exchange. So, an ETF is a bundle of stocks. Just like an index, has a broad spectrum of all the companies in a particular industry, let's say the energy industry. What you would do with an ETF would be go into the energy sector and you would use fundamentals instead of technicals to look through and see which companies you think have the best outcome for the next 5 to 10 years. You would bundle those into an ETF and release those ETFs into the market to be traded just like a stock. When you are buying these ETFs, you are buying exposure to the price changes of those particular stocks or the underlying stocks that make up the basket that is the ETF. Authorized participants create them, but you can also create them with a lot of different rules to them. You can have them so that if the price of the underlying stocks go up $1, you can get 2, 3, 5x leverage on them. So for every $1 in the underlying stocks, you make $2 or $3 or $5, for an example. You can also make it so that if you buy the ETF, it might be a short ETF. So by buying into that ETF, you make money on the underlying stocks dropping in price. So there's a lot of different things you can do with ETFs to give people a variety of different products. The goal is that they beat the indexes that they are somewhat mimicking. Say the energy industry again. The ETF will attempt to get the appropriate stocks into its basket that are going to beat the overall industry index. Hopefully, if enough of the people in a company have done the right research, then they will have searched out the companies with good fundamentals that are going to make you that money in the long term. The thing is, once these ETFs do make it out into the market, they are not managed, which means that what are in the stock are often not in the ETF. They're not changed or moved around so much, or at least not very often. They might have a quarterly or monthly rebalancing where they shift how many of each stock are in the ETF based off of the performance of each individual stock and company that makes up the bundle of stocks. Since around '07, '08, ETFs have exploded in popularity. Indexes, when they originally were brought into the market, it took around 30 years for the indexes to get about a 10% market share. ETFs got a 10% market share in 7 years. That is an extreme adoption, and it's also a really easy way to get price exposure to an entire industry for relatively cheap investment. So that is an ETF, simply a bundle that any authorized participant can create with all sorts of different rules. And yeah, basically they try to beat the underlying indexes that they are somewhat mimicking. Now, if you'd like to know how companies operationally short ETFs to target specific companies, I'll be doing a video here shortly that explains how ETFs are being used to destroy the price of one particular GameStop company. It's pretty interesting, and there's a lot of data that proves that it is being done very regularly. And join me in that video. I'll explain exactly how ETFs are used to operationally short companies. Know it, Ollie out.